Imagine you're driving a massive, like fully loaded cargo truck down a really steep, winding mountain road.
Oh, man. And it's probably the dead of night, right?
Exactly. Dead of night, pitch black. And you have to ride the brakes to avoid just, speeding out of control and flying off the cliff.
Right, which in our world of macroeconomics, that terrifying plunge off the cliff is runaway inflation.
Yes, exactly. But here's the catch, right? If you slam on the brakes too hard, the truck's engine just completely stalls out.
You lose power steering, you're stranded. It's a nightmare.
Yeah, and that stalled engine is economic growth. So it's this incredibly precarious, anxiety-inducing balancing act that central bankers face literally every single day.
It really is.
But this year, the Reserve Bank of India did something pretty extraordinary. They actually found the absolute perfect speed.
They did. They managed to navigate the hairpins, keep the engine humming, and they engineered a really rare Goldilocks scenario.
Right? So welcome to this deep dive. If you're listening to this, you've probably got a towering stack of textbooks and regulatory documents sitting on your desk right now.
Oh, yeah. The fun stuff.
Yeah, and you're staring down the barrel of one of the most notoriously difficult professional banking and finance exams in the industry.
We know the feeling. As peer analysts, we've totally been there. The pressure is intense.
It really is.
Yeah.
And you also know that the Reserve Bank of India's annual report for 2025-26 is this dense, intimidating brick of a document.
Specifically, Chapter 3.
Chapter 3.
Right. Monetary policy operations. That is the one that keeps people up at night.
Because it's just packed with, shifting frameworks, mechanical policy adjustments, and incredibly dense regulatory text.
Yeah, and it's exactly the kind of chapter that can absolutely make or break your final score.
Because it's not just rote memorization.
Exactly. It tests your fundamental comprehension of how the financial plumbing actually works. But look, you can push that heavy textbook to the side for today.
Please do.
We have thoroughly parsed every section, every subsection, every footnote, and, every underlying economic argument embedded in Chapter 3.
We did the heavy lifting so you don't have to.
Right. We're going to unpack all that dense regulatory jargon and translate it into the clear, mechanical language of the financial markets.
We're basically stepping in as your senior analyst guides today. We'll walk you through this material so comprehensively that you'll understand not just what the RBI did, but the underlying logic of why they did it.
Because when you understand the why, you really don't need to memorize the what. It just becomes second nature.
Exactly. That's the whole goal here. So let's trace the narrative arc of the year. The global economy in 2025 was an incredibly tricky environment to operate in.
To say the least.
Right. The headline number that the RBI anchors its global context to is 3.4% global growth, which, on paper, that sounds perfectly fine.
It's totally normal.
Right. But that surface number hides a massive amount of turbulence.
It absolutely does. A 3.4% global growth print is solid, but you have to look at the severe headwinds that were threatening to tear that growth apart.
Right. Like what specifically?
Well, we were looking at really high trade tariffs, incredibly elevated policy uncertainty across major economies, soaring public debt burdens in the post-pandemic era.
Oh, and the geopolitical tensions.
Yeah, severe geopolitical tensions. The resurgence of supply shock-driven inflation risks following the conflict in West Asia was particularly terrifying for central banks.
I can imagine. But what makes this specific period fascinating for an analyst, and what the RBI annual report focuses heavily on, is the macroeconomic divergence.
Right. It was really a tale of two worlds.
Exactly.
Yeah.
Advanced economies, like the U.S. and the Eurozone, they were largely dealing with sticky inflation.
Yeah, inflation that just stubbornly refused to come down to their target levels.
Right. So their central banks were trapped in a vice. They were trying to balance the mandate of crushing inflation against the desperate need to minimize, adverse spillovers that could trigger a severe recession.
It's a brutal spot to be in.
Yeah. Yet, despite these sticky inflation points in advanced economies, the broader global trend across emerging markets leaned toward a cautious easing cycle.
Right. Central banks globally were trying to progressively become less restrictive just to let their economies breathe a little bit.
And India navigated this chaotic external environment exceptionally well, which actually brings us to the actual policy moves.
Let's lock in our first major data point for your exam prep right here.
Yes, grab a pen. You need to listen incredibly closely to this timeline distinction, because test makers love to exploit it.
They live for this kind of trap.
I really do. Okay, so the Reserve Bank of India enacted a cumulative 100 basis points reduction in the policy repo rate strictly during the 2025-26 financial year.
Dropping the final rate to 5.25%.
Right, 5.25. Now, here is where you have to read the multiple choice question really carefully. If the exam asks about the total easing cycle since February 2025, the answer is 125 basis points.
Yeah.
But if the question specifies the financial year 2025-26, which strictly runs from April to March, the correct answer is exactly 100 basis points.
That is a classic textbook exam trap. They will absolutely put both 100 and 125 in the options, just waiting for you to misread the date parameter.
So write that on a sticky note.
Definitely. Now, the primary driver behind this aggressive, front-loaded easing cycle in India was a beautiful structural downward trend in headline consumer price index, or CPI, inflation.
Right, it trended down to historical lows throughout the entire year.
Yeah, and the RBI attributes this largely to severe food price deflation, which, I mean, food is massive in the Indian consumption basket.
Huge.
Right. So it was food price deflation plus the long-term stabilization effects of the goods and services tax, or GST, rationalization.
In fact, if you look at the 2012 equals 100 base series, headline inflation hit an all-time historical low in October 2025.
Which is wild to think about given the global context.
Yeah. And this sharp, undeniable moderation in inflation gave the Monetary Policy Committee, the MPC, the exact breathing room they needed to aggressively support growth.
Right. They could cut rates without risking a secondary inflation spiral.
So let's look at the mechanics of how the MPC actually deployed those rate cuts. We really need to go meeting by meeting here.
Yeah, because understanding how their rationale and their official policy stances shifted is, well, it's critical for understanding central bank communication.
Okay, so the financial year kicked off with the April 2025 MPC meeting. The RBI came out of the gate with a standard 25 basis point cut.
Moving the repo rate from 6.25% down to 6.0%.
Right. But the more important signal was that they formally changed their stance from neutral to accommodative.
Yeah, the stated rationale in the minutes was that they observed steady baseline growth, a reviving manufacturing sector, and notably strong rural demand.
So they wanted to firmly signal to the market that they were growth supportive while headline inflation was, behaving itself.
Which perfectly sets the stage for the June 2025 meeting. And listen, if you highlight one meeting in your notes today, make it this one.
June 2025.
June 2025. The MPC decided to front-load their firepower with a massive 50 basis point cut.
Instantly bringing the repo rate down to 5.50%.
Right, but, and you must note this for your exam, this was not a unanimous consensus decision.
Right, there was some drama.
A little bit, yeah. It was a 5-to-1 majority vote. One dissenting member preferred a more cautious 25 basis point cut.
So why did the majority go so big?
The majority rationale for this aggressive 50 basis point strike was a significant downward revision in the RBI's internal CPI projections, driven almost entirely by rapidly softening food inflation.
Okay, but here is the critical analytical pivot, and this is what confuses a lot of students. Alongside this massive rate cut, the MPC abruptly reverted their policy stance from accommodative back to neutral.
Yep.
So I want to pause right there because that sounds completely contradictory to a casual observer.
It really does.
Right. If I'm looking at a 50 basis point cut, which is a huge injection of monetary stimulus, why on earth would they simultaneously downgrade their stance to neutral? It feels like hitting the gas pedal and shifting into neutral gear at the exact same time.
It feels totally counterintuitive, but it's actually a masterclass in expectation management.
Oh, really? How so?
Well, the MPC explicitly acknowledged in their statement that after a cumulative 100 basis points of cuts since the cycle began in February, there was suddenly, quote, limited policy space left for further downward adjustments.
Ah, okay.
Right. By shifting the stance back to neutral, they were effectively telling the bond markets, look, we're giving you a massive cut today to secure the growth recovery, but do not price in a continuous string of cuts for the rest of the year.
Like the heavy lifting is done, don't get greedy.
Exactly. A neutral stance simply means the central bank is not committing to the direction of the next move.
They could hike, they could cut, they could hold.
Right. Purely based on incoming data. It gives them maximum optionality.
So they fired their biggest bazooka round, but immediately tapped the microphone to tell the market the armory was getting low.
That is a perfect way to put it.
That context makes total sense. And it explains exactly what happened at the next meeting in August 2025. The MPC hit the pause button.
They held the rate at 5.50% and maintained that neutral stance.
Because the global disinflation momentum they had been riding was, starting to fade a bit.
Yeah. But locally, something bizarre happened in August. Core inflation actually edged up to 4.4%.
Right, and what's fascinating about the RBI's analysis here is that this uptick in core inflation was heavily driven by a surge in international gold prices.
Even while the headline inflation number continued to drop for the 8th consecutive month.
It's so weird. This specific dynamic is why central banking relies so heavily on human judgment rather than just like algorithmic rules.
Absolutely. And as an analyst taking this exam, you have to deeply understand the structural divergence between headline and core inflation.
Let's break that down.
Okay, so headline inflation measures the entire basket of goods and services. It includes everything, most notably volatile items like food and energy prices.
Which can swing wildly due to, say, a bad monsoon or a sudden oil embargo.
Right. Core inflation, on the other hand, deliberately strips those volatile food and energy items out. It's trying to reveal the underlying sticky structural inflation trend in the broader economy.
Now, normally, if core inflation is rising, a central bank gets incredibly nervous, right?
Right.
Because it implies broad-based demand is overheating, people are buying too much stuff.
Normally, yes, but the MPC looked under the hood of that 4.4% core print. They saw that the spike was highly concentrated in the clothing and footwear and personal care and effects sub-indices.
And those sub-indices are heavily weighted with gold and precious metals.
Precisely.
Right. Because international gold prices surged due to global uncertainty, it artificially inflated India's core CPI number, even though domestic consumers weren't exactly out there, panic buying washing machines and cars.
Exactly. The RBI recognized that the surge in gold was an exogenous shock.
It's an external global pricing event, not a symptom of overheating domestic demand.
Right. If they had hiked rates in a panic to crush that core inflation uptick, they would have been strangling the domestic economy over a global gold rally they have literally zero control over.
Wow.
So they held the line at 5.50% in August because they analytically saw right through the statistical noise.
That's brilliant. And they held the line once again in October 2025. Another pause at 5.50%, still maintaining the neutral stance.
The justification there was just solid macroeconomic data. Robust Q1 GDP growth came in at 7.8%, and overall inflation remained deeply subdued.
The RBI specifically noted the ongoing benefits of GST rationalization measures that led to structural price corrections, particularly in sectors like motor vehicles.
Yeah, they essentially felt that the massive stimulus from their previous rate cuts was still slowly working its way through the commercial banking system.
They didn't need to force the issue.
Right. Which leads us perfectly into the December 2025 meeting.
Ah, yes, the defining Goldilocks quarter we talked about in the intro.
The data that came in for December was almost unbelievably good. Q2 GDP growth hit a staggering six-quarter high of 8.2%.
8.2%. The economy was absolutely roaring.
It was. But simultaneously, average headline inflation collapsed down to 1.7%.
To put that 1.7% in context to the exam, it is actually below the strict 2% lower tolerance band of the RBI's mandated inflation target.
Right. You had booming, accelerating growth alongside prices that were virtually standing still or even deflating.
Okay, I have to step into the shoes of a student staring at this data set, because the MPC's reaction to this Goldilocks data seems completely baffling on paper.
Oh, I know where you're going with this.
Right. If I'm reading this right, inflation dropped to 1.7% in December. It literally broke through the floor of the legal 2% tolerance band. The mandate says inflation should be 4%. So, if inflation is practically dead, why did the MPC only cut the rate by a meager 25 basis points down to 5.25%?
It's a great question.
And more importantly, why on earth did they keep a neutral stance? If inflation is at 1.7%, why not aggressively shift back to accommodative and slash rates by another 50 or 75 basis points to get inflation back up to target?
It is the most logical question you could ask, and understanding the answer is the key to understanding the entire philosophy of the Reserve Bank of India.
Okay, lay it on me.
The answer lies in the concept of forward-looking caution and the mechanics of base effects. Look, a central bank drives the economy looking through the windshield, not the rearview mirror.
I like that.
Yes, the printed inflation number for December was 1.7%. But the MPC knew exactly why it was 1.7%.
Why?
They knew that favorable statistical base effects from the previous year, combined with highly transient temporary food price deflation, like a massive bumper crop of vegetables hitting the market all at once, were heavily suppressing that headline number. The RBI's internal projection models showed that as soon as those base effects wore off in the coming months, both core and headline inflation were going to naturally gravitate right back up toward the 4% target.
Okay, so they knew the 1.7% was basically a statistical illusion that was going to evaporate anyway?
Exactly. But there was a second, arguably more critical reason they held back. They were staring intently at the global macroeconomic horizon.
The external headwinds.
Yes, external headwinds were intensifying rapidly. Advanced economies were keeping their interest rates higher for longer because of their sticky inflation. Global capital flows were becoming highly volatile.
Oh, I see. So if the RBI slashed domestic interest rates too aggressively and shifted their stance to accommodative while inflation was temporarily low, they risked dangerously narrowing the interest rate differential between India and the United States.
Exactly. And if the interest rate differential narrows too much, what happened?
Foreign investors pull their capital out of Indian markets to chase safer, higher yields in U.S. Treasuries.
Precisely. It could trigger massive, destabilizing capital outflows, which would crush the value of the rupee and instantly import inflation back into the country via higher costs for imported oil and electronics.
Wow, okay. So they cut by 25 basis points in December, simply because the low inflation data gave them a brief window to offer some mild support to the commercial sector.
Yes, but they rigidly stayed neutral to retain complete flexibility. They needed the market to know they were ready to pivot instantly if global shocks hit.
And as it turns out, their paranoia was completely justified. By the final meeting of the financial year in February 2026, those external headwinds they feared actually materialized.
Global volatility spiked.
Consequently, the MPC paused at 5.25% and firmly kept the neutral stance. Domestic economic activity was still impressively resilient, CPI was behaving, but the global environment was simply too fragile and unpredictable to justify any further easing.
And that cautious pause marks the complete narrative arc of the 2025-26 easing cycle. They navigated the descent perfectly.
Which brings us to a massive structural component of the exam. The MPC does not just pull their inflation targets out of thin air.
No, they do not.
They operate under a very strict, legally binding mandate. This is where we need to dive deep into the second review of the Flexible Inflation Targeting Framework, or FIT.
FIT. If you want to talk about foundational regulatory architecture that will absolutely be tested, this is it. Pay attention here.
Let's lay the legal bedrock first. If you were taking notes, grab your pen again. The Flexible Inflation Targeting Framework was originally adopted in India in May 2016.
The specific legal provision, and you must memorize this exact section, is Section 45A of the Reserve Bank of India Act, 1934.
Do not let the exam trick you by listing the Banking Regulation Act or the Foreign Exchange Management Act.
No, it is Section 45ZA of the RBI Act, 1934.
Got it. The framework legally mandates that the central government of India, in direct consultation with the Reserve Bank, determines the official inflation target, and they are required to review and set this target once every 5 years.
Right. So the first 5-year review happened in March 2021, right in the thick of the post-pandemic recovery. So, mathematically, the critical second review was due by March 2026.
But the RBI doesn't just sit in a closed room and dictate the target, right?
No, they went through an exhaustive consultation process. On August 21st, 2025, they released a massive discussion paper designed to gather feedback from every corner of the economy.
Commercial banks, academic economists, industry chambers, market participants.
Everyone. And they essentially put 4 existential questions up for debate regarding the framework.
Okay, what were the 4 questions?
First, should we continue to target headline inflation or should we switch to targeting core inflation?
Okay.
Second, is the specific number of 4% still the optimal target for a developing economy? Third, is the plus or minus 2% tolerance band giving us a range of 2 to 6% still appropriate?
And the fourth?
Fourth, should we maintain a specific point target or should we abandon it and just target a broad range?
I want to dig into that first debate because it's fascinating. Headline versus core inflation.
It's a great debate.
The feedback data the RBI published is incredibly telling. There was an overwhelming, almost unanimous consensus. 92% of all respondents arguing fiercely to keep headline CPI as the official target.
Yep, 92%.
But why? I mean, if we just discuss how volatile food prices can create statistical illusions like that 1.7% drop, wouldn't it be intellectually and operationally cleaner for the RBI to just target core inflation, which strips out all that noise? Why tie your hands to the price of tomatoes?
From a purely academic, theoretical standpoint, many Western economists would argue exactly that. Core inflation is easier to model and it's easier to predict.
Right.
But the RBI operates in the reality of the Indian economy. In a developing economy like India, food and fuel make up a staggering portion of the average household's consumption basket.
Like nearly 50% for many demographics, right?
Exactly. So if the central bank formally adopts a policy to target core inflation,
Mm.
they are essentially telling hundreds of millions of citizens, hey, we don't care if the price of your daily rice, wheat, and cooking gas doubles as long as the price of televisions and haircuts is stable.
Oh, wow. Yeah, that would be a catastrophic failure of public trust.
It would. The central bank's credibility is its most powerful weapon. If the public feels the RBI's target doesn't reflect their lived reality at the grocery store, inflation expectations become completely unanchored.
And then the policy loses all its power.
Exactly. That is why 92% of the market said you must stick to the headline number.
The reality of the consumer dictates the policy framework. That makes perfect sense.
It really does.
Okay, the second point of feedback was regarding the target number itself. And again, 90% of respondents wanted to firmly retain the 4% optimal target.
They felt it was a perfect balance. Low enough to protect purchasing power, but high enough to grease the wheels of a rapidly growing developing economy.
But the debate around the tolerance band, that plus or minus 2%, is where the friction really showed up.
Yes, this is where the industry was somewhat divided. A solid majority, about 65%, favored keeping the existing 2% to 6% band.
But a very vocal minority, roughly 35%, actually advocated for tightening and narrowing the tolerance band.
Their argument was quite sophisticated, actually. They essentially said, look, the RBI has built up so much institutional credibility and muscle memory over the last decade of inflation targeting, the markets trust you.
So they wanted to flex that credibility.
Right. They said it is time to tighten the band to, say, plus or minus 1% to further anchor inflation expectations and prove that India is maturing into an advanced economy-style monetary regime.
But the RBI rejected that 35% minority. Why? If narrowing the band proves you're a mature, credible central bank, why keep the wide 400 basis point playground?
Because while narrowing the band is intellectually appealing, practically, it would be a total nightmare in an economy subject to frequent, violent supply-side shocks.
Like agriculture.
Yes. India's agricultural output is still heavily dependent on the vagaries of the monsoon. The country is also a massive net importer of crude oil.
So if the RBI narrowed the band to, say, 3 to 5%.
A single bad monsoon or a brief spike in Brent crude could instantly push inflation to 5.5%.
And under a narrow band, the RBI would be legally forced to immediately hike interest rates to crush demand.
Exactly, violently disrupting economic growth just to fix an inflation spike caused by a lack of rain. It makes no sense.
Yeah, the wider 2 to 6% band provides essential breathing room. It allows temporary shock-driven inflation to naturally dissipate without forcing the central bank into erratic, destructive monetary policy reactions.
Which brings us to the ultimate legal outcome of all this debate. This is your next non-negotiable exam takeaway.
Write this down.
After all the feedback, on March 25, 2026, the government of India issued a formal Gazette notification, specifically SO 1580E. Yes. Officially retaining the CPI headline inflation target at exactly 4%, with the upper tolerance level remaining at 6% and the lower tolerance level remaining at 2%.
And the absolute critical detail you must memorize for the exam is the validity period of this new mandate.
This framework is legally locked in for the period of April 1st, 2026 to March 31st, 2031.
For the next 5 years, the rules of the game are set in stone.
And before we leave this topic, we need to quickly address the fourth question the RBI asked the market: point versus range targeting.
Right. The RBI asked if they should just drop the 4% point target and simply tell the market, our goal is to keep inflation between 2 and 6%.
The market overwhelmingly rejected that idea, and the RBI agreed.
I think the easiest way to conceptualize why point targeting is mathematically superior to range targeting is to think about driving on a highway.
I love this analogy.
Imagine the 4% target is the exact speed limit you want your cruise control set to. It's your single nominal anchor. The 2% and 6% tolerance levels are the rumble strips on the far left and right edges of the lane.
Right.
If the government just tells drivers, hey, stay anywhere between 20 and 60 miles per hour, traffic flow becomes incredibly unpredictable.
Pure chaos. Some cars are crawling, some are speeding, and nobody knows what the guy next to them is going to do.
Exactly. Financial markets are exactly the same. Corporations, bond traders, labor unions, they need that single specific nominal anchor, that exact 4%, to accurately price 10-year infrastructure bonds or negotiate long-term wage contracts.
If the RBI just gives a vague range, Long-term pricing becomes chaotic and risk premiums skyrocket.
The band just acknowledges that the macroeconomic truck might drift slightly left or right due to the wind, but the steering wheel is always pulling back dead center to 4%.
That analogy perfectly captures the macroeconomic necessity of a point target. It anchors expectations. Now, if the policy rate and the inflation target are the steering wheel and the accelerator, we need to look at what's actually flowing through the engine block.
Ah, the plumbing.
Yes. That brings us to the mechanics of liquidity management and the massive operating framework revamp of 2025-26. To understand the sweeping changes the RBI made, you first have to understand the liquidity drivers that were overwhelming the system during the year.
The Indian banking system was absolutely awash in cash, but it was highly volatile cash.
Right. The RBI was not dealing with a stagnant pool of money. They were dealing with a whitewater rapids situation.
The annual report identifies three primary drivers of this liquidity chaos. First, massive and volatile capital flows. We're talking billions of dollars of foreign portfolio investment moving in and out of the Indian equity and bond markets based on U.S. Federal Reserve commentary.
Exactly. Second, a significant expansion in currency in circulation, or CIC. As the economy grew and festive seasons hit, the public was physically holding and demanding more cash, which drains liquidity from the banking system.
And third, incredibly volatile changes in the government of India's cash balances maintained with the RBI.
That third point is so crucial. The government changed how it manages its money. They moved to a just-in-time funder model for centrally sponsored schemes.
What does that mean practically?
Well, instead of dumping billions of rupees into state government bank accounts months in advance where it would just sit as idle liquidity in commercial banks, the government kept the cash in its own account at the RBI until the exact moment it was needed.
Oh, wow. Furthermore, massive corporate tax collection days would suddenly suck trillions of rupees out of the commercial banking system overnight and lock it in the government's RBI account.
Right. So because of this violent structural shift in how liquidity was moving, exacerbated by 247 digital payment systems like UPI moving money at the speed of light, the RBI realized their old plumbing system was breaking down.
They had to adapt. And here is your key exam takeaway for this segment. On September 30, 2025, a completely revised liquidity management framework was put into place.
But before we look at what changed, you need to memorize what did not change.
Right. The weighted average call rate, or the WACR, was explicitly retained as the single operating target of monetary policy.
And it operates within a symmetric policy corridor of 50 basis points around the policy repo rate.
Let's break down why the WACR is the holy grail of daily central banking. The WACR is the actual real-world interest rate at which commercial banks lend to each other overnight on an unsecured basis.
Meaning without pledging government bonds as collateral.
Right. The RBI announces a policy repo rate of, say, 5.25%, but that's just a number on a press release.
The RBI's entire daily operational mission is to manipulate the amount of cash in the banking system so precisely that when HDFC Bank calls up State Bank of India at 4:00 p.m. to borrow a billion rupees overnight, the interest rate they negotiate is exactly 5.25%.
If the system has too much cash, the WACR crashes below the repo rate. If there is a cash shortage, the WACR spikes above it.
So the RBI is constantly adding or draining cash to keep that WACR pegged to the repo rate. But how they achieve that daily balance changed fundamentally on September 30.
And this is the major mechanical shift you must know. The RBI officially discontinued the 14-day variable rate repo, or VRR, and the 14-day variable rate reverse repo, VRR, auctions as their main default liquidity operations.
Instead, they announced that transient liquidity would now be managed through 7-day and other shorter tenors, ranging from overnight up to 14 days. But the 14-day operation was dethroned as the default anchor.
I have to play devil's advocate here.
Do it.
The 14-day VRR and VRR framework was the cornerstone of the RBI's liquidity management for years. It forced banks to plan their liquidity needs over a 2-week horizon, matching the reserve maintenance cycle.
Yep.
Why break a system that worked?
Yeah.
Why shift the burden to 7-day and overnight operations? Doesn't that just create more daily operational stress for the RBI's trading desk?
It creates immense operational stress for the RBI, but they had absolutely no choice because the velocity of money had fundamentally changed.
Because of the capital flows.
Exactly.
Yeah.
Capital flows and government cash balances were swinging wildly on a daily basis. Let's say the RBI locked up 2 trillion rupees of excess bank liquidity in a 14-day VRR auction on a Monday.
Okay.
But on Wednesday, global markets panic. Foreign investors pull $1 billion out of India, and suddenly the domestic banking system is facing a massive cash deficit.
Oh, I see.
The RBI cannot easily give that 2 trillion rupees back to the banks because it is legally locked up in the 14-day contract for another 12 days.
So the banks panic, the WACR spikes, and monetary transmission breaks down.
Precisely. The RBI realized that in an era of rapid capital volatility, locking up or injecting funds for 14 days was dangerously rigid. They needed the extreme agility of 7-day and overnight operations to fine-tune the system's cash levels on a daily basis.
They traded stability for agility? That makes perfect mechanical sense. They shortened the leash so they could react faster. Now, let's look at the staggering statistics of this liquidity environment, because this is where the exam will test your understanding of the new tools.
The numbers are wild.
System liquidity throughout the year was in a massive persistent surplus. We're talking about an average of 1.86 lakh crore rupees sloshing around the system every single day.
1.86 lakh crore.
And this leads to an incredibly important statistic that defines the year. Key exam takeaway here. Absorption of this excess cash through the Standing Deposit Facility, the SDF, constituted an overwhelming 84.9% of the average total absorption under the Liquidity Adjustment Facility, or LAF.
84.9%. That is 2.02 lakh crore rupees.
Meanwhile, because of this massive surplus, the WACR averaged 7 basis points below the policy repo rate, compared to being 6 basis points above it the previous year.
Those numbers are not just trivia. They tell a profound story about risk aversion in the banking sector. Let's really unpack the concept of the Standing Deposit Facility, or SDF, and why its usage dominated the system at 84.9%.
The SDF is a relatively new tool, right?
It is. It forms the absolute floor of the RBI's policy corridor. It sits exactly 25 basis points below the repo rate. It allows commercial banks to park their excess liquidity with the RBI without the RBI having to provide government securities to the banks as collateral.
In a massive surplus environment, banks are swimming in cash. But here is the puzzle. Why would a bank voluntarily park billions of rupees in the SDF, earning the absolute lowest possible interest rate in the entire financial system, rather than lending it out in the interbank market to earn a higher yield?
The answer comes down to a behavioral concept called precautionary liquidity.
Let's visualize this.
Okay.
Imagine you're the head treasurer of a major commercial bank in Mumbai. It's Friday afternoon, 4:03 p.m., right before a long 3-day holiday weekend.
You're ready to go home.
Exactly. Your bank's balance sheet is sitting on a massive pile of excess cash because corporate loan demand was a bit soft this week. You have a choice.
You could lend that cash out in the overnight call money market to another bank. You might scrape an extra 5 or 10 basis points of yield.
But you're looking at your Bloomberg terminal, and things feel incredibly volatile globally. Maybe there's tariff news breaking in Washington, or geopolitical tensions flaring up in West Asia.
If you lend that money unsecured to another bank, you're taking on counterparty risk over a 3-day weekend when markets are closed.
Right. What if that bank has undisclosed exposure to a failing foreign derivative? You do not want to risk your bank's capital for 5 measly basis points.
So you choose the alternative.
Exactly. Instead of chasing pennies on the interbank market, you take those billions and you park them directly in the RBI's Standing Deposit Facility.
You don't need the RBI to give you collateral because the RBI cannot default.
It is total, absolute safety, zero counterparty risk, instant liquidity whenever you need it.
Even if the yield is literally the floor of the policy corridor, it acts as the ultimate financial safety blanket for your balance sheet.
That is precautionary liquidity in action, and that is exactly why SDF usage was so incredibly high. The banks preferred the safety of the RBI over lending to each other in a volatile world.
Exactly right. And because there was so much cash sloshing around seeking that safety and so few banks desperate to borrow, the overnight lending rates naturally softened.
That is the exact mathematical reason why the WACR averaged 7 basis points below the repo rate for the entire year.
It was fundamentally a borrower's market in the interbank space. The RBI was trying to pull the WACR up to the repo rate, but the sheer gravity of the surplus cash kept dragging it slightly below.
Which perfectly transitions us into how the RBI tactically navigated this environment quarter by quarter. We know the whole year was largely defined by a surplus, but it was not a smooth ride.
Not at all.
How did the RBI tactically manage the bumps along the road? In quarter one, there was an ample almost overwhelming surplus.
In fact, liquidity was so comfortable that the RBI actually discontinued their daily variable rate repo auctions on June 11.
And then had to aggressively resume variable rate reverse repo VRR auctions on June 27 just to mop up all the excess cash that was threatening to push the WACR too far below the corridor.
But then Q2 hits, and the dynamics shift. We saw continued surplus generally, but with a brief, incredibly sharp deficit in late September.
What caused that sudden deficit?
It was a classic combination of factors that drained liquidity. First, there was a massive buildup of Government of India cash balances. Corporate advance tax payments were due.
Oh, right. Which means trillions of rupees were drained out of commercial bank accounts and transferred into the government's account at the RBI, temporarily leaving the banking system dry.
Exactly. Coupled with this, the RBI was actively selling dollars in the forex market to stabilize the rupee against global volatility. When the RBI sells dollars, they absorb rupees from the market, which further sucks rupee liquidity out of the banking system.
By Q3, the overall surplus moderated significantly. Higher government spending was trying to eject cash back into the economy, but it was fighting a losing battle against massive foreign capital outflows and a huge spike in currency in circulation.
Why the spike in CIC? Because it was the festive season.
Right. Hundreds of millions of people were withdrawing physical cash from ATMs to spend on Diwali and other festivals.
The system even briefly turned into an outright deficit in mid-December due to another massive round of advanced tax outflows.
Finally, in Q4, government spending picked up heavily, durable liquidity measures kicked in, and the surplus expanded dramatically once again to close out the financial year.
You mentioned durable liquidity measures, and this is absolutely critical for the exam.
Yes, listen up here.
When the banking system hit those intermittent pockets of severe tightness in Q2 and Q3, the RBI didn't just rely on overnight or 7-day repo auctions. Short-term repos are just temporary band-aids. The money has to be returned in a week.
The RBI needed to inject permanent structural liquidity into the foundation of the banking system.
This brings us to a highly critical exam takeaway regarding the durable liquidity injection measures deployed in 2025-26. The most significant aggressive move was the deployment of 4 separate tranches of cash reserve ratio, or CRR, cuts, which totaled 100 basis points.
Let's deeply emphasize the mechanical magnitude of a CRR cut, because it is one of the most powerful tools a central bank possesses.
It really is.
The cash reserve ratio is the strict percentage of a commercial bank's total deposits that it is legally mandated to hold entirely in cash within the vaults of the RBI.
And crucially, this trapped cash earns absolutely zero interest for the bank.
By cutting the CRR requirement by 100 basis points, the RBI instantly unlocked approximately 2.5 lakh crore rupees of durable, permanent liquidity.
And the beauty of a CRR cut is the money multiplier effect. That 2.5 lakh crore rupees does not have to be paid back to the RBI in 7 or 14 days like a repo loan.
It's permanently released back onto the commercial bank's balance sheets.
Right. The banks can instantly take that zero-yielding cash and lend it out to corporations or buy government bonds, which instantly multiplies the credit creation in the broader economy.
Alongside the CRR cuts, the RBI deployed outright open market operation, or FOMO purchases. They stepped into the secondary market and outright bought government securities from commercial banks, permanently replacing those bonds with hard cash.
Notably, this included a massive, targeted 1 lakh crore rupees of FOMO purchases specifically executed in March 2026.
By March.
They did this to ensure the financial year ended with absolutely ample liquidity, preventing any year-end interest rate spikes that usually occur when banks close their books.
Furthermore, they utilized long-term Forex USDNR buy-sell swaps. They bought dollars from the banks and injected rupee liquidity into the domestic system,
simultaneously building their Forex reserves while solving the domestic cash tightness.
But here is the ultimate point. All of these complex mechanical operations, the CRR cuts, the OMOs, the shift to 7-day repos, the massive reliance on the SDF, had one single overarching ultimate goal: credit transmission.
Exactly. Central banking is ultimately about the real economy. The Monetary Policy Committee can sit in their boardroom and cut the repo rate by 100 basis points all day long.
But if the commercial banks refuse to lower the actual lending rates for a farmer taking out a tractor loan or a corporation trying to build a new factory, the entire monetary policy exercise is completely dead on arrival.
The central bank is just pushing on a string.
But because the RBI's liquidity management ensured that system conditions were so incredibly supportive and a persistent surplus, the banks were flush with cash.
And because they were flush with cash, that 100 basis point policy rate cut transmitted beautifully and rapidly to the real economy.
And the specific mechanism of how that transmission occurred is your next major key exam takeaway.
The annual report notes a highly significant foundational structural shift in the Indian credit market. There was a massive, noticeable increase in the proportion of outstanding loans linked to external benchmark-based lending rates, or EBLR.
And simultaneously, there was a concomitant accelerating drop in loans linked to the old marginal cost of funds-based lending rate, or MCLR.
You absolutely must understand the mechanical difference between these two interest rate regimes for the exam.
Let's break down the mechanics. Under the old MCLR system, a commercial bank calculates your loan interest rate based on its own internal cost of funds, how much interest the bank is paying to its depositors and bondholders.
The fatal flaw of the MCLR system for monetary policy is that it is incredibly slow and sticky.
Right. Banks usually only reset an MCLR-linked loan once a year. So let's say the RBI cuts the repo rate by 50 basis points in June to stimulate the economy. If your mortgage is on an annual MCLR reset date scheduled for next February, your monthly payment does not change in June.
You're trapped waiting 8 months for your reset date, totally missing out on the immediate financial relief.
The RBI's policy cut takes nearly a year to reach your wallet.
But under the newer EBLR regime, the friction is destroyed. Under EBLR, the bank is legally required to link your loan interest rate directly to an external benchmark, which in almost all cases is the RBI's exact policy repo rate itself.
So if the MPC cuts the repo rate by 50 basis points on a Tuesday morning, the interest rate on your auto loan or your mortgage mathematically adjusts downward almost immediately, usually by the next billing cycle.
Your EMI gets cheaper instantly. You have more disposable income the very next month. It ensures rapid, frictionless transmission of monetary policy directly from the central bank's boardroom to the consumer's wallet.
The fact that the Indian credit market has structurally shifted toward EBLR means the RBI's policy tools are sharper and more effective than ever before.
That frictionless transmission is vital for macroeconomic management. However, the annual report is not entirely celebratory. It also details an ongoing stubborn friction in transmission between scheduled commercial banks, the SCBs, and non-banking financial companies, the NBFCs.
The data clearly shows that NBFCs inherently maintain significantly higher lending rates and exhibit much slower downward transmission when the RBI cuts rates compared to commercial banks.
And as an analyst, you need to understand why this structural premium exists. It's not because NBFCs are just greedy. It comes down to fundamental funding structures and risk profiles.
Let's compare the balance sheets. Scheduled commercial banks are funded by incredibly low-cost retail deposits.
Right. When you keep your money in a savings account earning 3% or a current account earning 0%, you are providing the commercial bank with massively cheap funding.
They can blend that cheap funding to offer lower lending rates.
Exactly. But NBFCs, the shadow banking sector, are legally prohibited from accepting demand deposits like checking or savings accounts. They cannot access that pool of cheap retail money.
To fund their lending operations, NBFCs have to borrow wholesale from the institutional bond market. Or worse, they have to borrow directly from the commercial banks themselves.
Their baseline cost of funds is structurally much higher from day one.
Furthermore, NBFCs typically lend to riskier subprime borrower profiles people or small businesses without formal credit histories who are rejected by the commercial banks.
Therefore, their final lending rates must mathematically incorporate both a higher cost of funds baseline and a significantly higher credit risk premium to cover potential defaults.
That is why transmission in the NBFC sector will always lag behind the commercial banking sector.
It is a textbook example of how institutional architecture dictates market pricing, which brings us perfectly into our final section, the forward agenda.
We know what the RBI navigated in the past year, but what did they actually accomplish structurally, and what are they setting their sights on for 2026-27?
First, looking back at the completed agenda for 2025-26, they checked off several major analytical boxes. They successfully completed a highly complex, multivariable study on estimating optimal system liquidity.
They also deeply analyzed the latest National Sample Survey Organization's household consumption expenditure data to better understand how inflation impacts different demographic baskets.
But here is the absolute key exam takeaway for their completed agenda. The RBI successfully expanded its coverage of sectoral credit deployment data to formally include housing finance companies, or HFCs.
Do not underestimate how massive this regulatory win is. For decades, the RBI meticulously tracked exactly how commercial banks deployed credit to various sectors, how much money went to agriculture, how much to heavy industry, how much to services.
But there was a glaring blind spot. A massive volume of mortgage lending and real estate financing in India happens entirely outside the traditional banking system, facilitated through housing finance companies.
By finally forcing HFCs to report and integrating them into the sectoral credit deployment tracking matrix, the RBI has effectively dragged a massive chunk of shadow banking data out of the darkness and into the light.
This provides the central bank with a vastly more accurate, holistic picture of systemic leverage, real estate exposure, and potential asset bubbles.
It's a massive leap forward in macroprudential regulation. That is transparency in action. Now, let's look at the horizon. The 2026-27 forward agenda is heavily tilted toward advanced economic modeling and sophisticated data analytics.
The RBI is not resting on its laurels. They are planning to comprehensively review and upgrade their core GDP and inflation forecasting models.
They want to expand the sectoral credit tracking even further to include other non-bank financial entities beyond just HFCs.
They are also reviewing the mechanics of their quarterly projection model to make it more sensitive to supply shocks.
But out of all these initiatives, two specific goals stand out as the absolute holy grail of modern central banking: estimating potential GDP and its optimal growth rate, and most importantly, estimating the natural real rate of interest.
Let's deeply unpack the natural real rate of interest because it's a theoretical concept that governs the entire underlying philosophy of monetary policy. In academic literature, it's often referred to as R star.
R star. The natural real rate of interest is a theoretical, completely invisible number.
It is defined as the exact, precise interest rate that neither stimulates the economy nor restricts it, while keeping inflation perfectly stable. It's the true, absolute neutral baseline.
If your central bank policy rate is below this natural rate, monetary policy is effectively expansionary. You are stepping on the macroeconomic gas pedal, encouraging borrowing, but risking future inflation.
If your policy rate is above the natural rate, policy is contractionary. You are riding the brakes, destroying demand, and risking a recession.
The ultimate problem for central bankers is that you cannot just look up the natural rate of interest on a Bloomberg terminal. It does not trade on an exchange. It can only be estimated through incredibly complex, fragile econometric models.
Exactly. And to make matters worse, the natural rate is not static. It constantly shifts beneath your feet based on deep structural factors. Shifting demographics, long-term productivity growth rates, and the massive tides of global capital flows.
I always think of estimating the natural real rate of interest like trying to find the exact temperature in a massive ballroom where nobody's sweating and nobody's shivering.
That sounds simple enough.
But here's the catch. The ballroom is constantly expanding, the insulation in the walls is degrading, someone keeps opening a window to a blizzard outside, and half the people in the room are suddenly running on treadmills.
It is an incredibly complex multivariable calculus problem, but getting that invisible shifting number right is the absolute difference between engineering a sustainable booming economy and accidentally triggering a severe crippling recession. It's the ultimate test of a central bank's analytical capability.
That relentless pursuit of precision, whether it's upgrading the econometric models to estimate R-star, dragging shadow bank credit data into the light, or completely overhauling the liquidity framework to manage the WACR on a 7-day rather than a 14-day cycle, is what defines the modern Reserve Bank of India.
The intense density and complexity of Chapter 3 that you are studying is not just bureaucracy for the sake of bureaucracy. It's simply a reflection of the sheer complexity of managing a $3.4 trillion developing economy that is rapidly integrating with an incredibly volatile, unforgiving global financial system.
So let's pull back and recap the massive journey we just took through this chapter. We navigated the initial global headwinds and saw how the RBI capitalized on a Goldilocks macro environment of crashing headline inflation and booming growth to execute a highly precise 100 basis point easing cycle strictly within the 2025-26 financial year.
We analyzed the fierce debate around the flexible inflation targeting framework, resulting in the legal cementing of the 4% headline point target and the 2 to 6% tolerance band all the way through to 2031.
We broke down the mechanics of the revamped liquidity framework, understanding why the RBI killed the 14-day VRR in favor of shorter tenors to manage capital volatility, and how commercial banks heavily relied on the standing deposit facility to park their cash as a precautionary safety blanket in a surplus environment.
And finally, we traced how all of that perfectly managed liquidity enabled frictionless, rapid credit transmission to the consumer through the structural rise of external benchmark-based lending rates, while the RBI aggressively works to bring shadow banking into the light.
Before we sign off, I want to leave you with a final provocative thought, something that isn't explicitly printed in the text of Chapter 3, but is deeply existentially relevant to the structural shifts we've discussed today.
We saw the RBI fundamentally alter its plumbing, dropping the 14-day variable rate repo for shorter 7-day and overnight operations entirely because they needed to react faster to extreme, unpredictable capital volatility.
As a student of finance and a future leader in this industry, ask yourself this. In an era where AI-driven algorithmic trading, 247 digital payment infrastructure like UPI, and tokenized financial assets can move billions of dollars across global borders in a matter of milliseconds, will central banks eventually be forced to abandon weekly or even daily liquidity management entirely?
Will the RBI of 2035 be forced to operate real-time, intraday dynamic liquidity corridors, adjusting repo rates and draining surplus cash minute by minute just to keep the system stable?
The velocity of money is accelerating at an unprecedented, terrifying pace, and the operating frameworks we study today will have to race just to keep up with the machines of tomorrow. The cargo truck is only getting faster, the brakes are becoming digital, and the mountain road is only getting steeper.
Thank you for joining us on this deep dive. We hope this comprehensive analytical breakdown has completely demystified the daunting mechanics of Chapter 3 for you.
You don't just know the facts now, you know the underlying why, and that is what separates a good student from a great analyst. Best of luck on your impending examination. You have the knowledge, you have the context, and you are absolutely going to crush it.